Welcome to StokTok's deep dive into Eni SpA. Eni is a vertically integrated global energy company headquartered in Italy, with operations across oil and gas exploration, production, refining, and renewable energy development. As of May 5th, the stock is trading at $56.50. Over the past 52 weeks, the shares have ranged from a low of $28.50 to a high of $58, which places the current price near the middle to upper end of that range. The 14-day relative strength index sits at 60.5, suggesting neutral momentum, not overbought, not oversold. The 50-day moving average is at $52.55, while the 200-day average stands at $40.58, indicating the stock is trading above both key trend lines. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Eni operates as a vertically integrated energy major with exposure to upstream oil and gas production, midstream and downstream refining, and power generation. The core revenue driver is the sale of oil, natural gas, and refined products to both regional and global markets. The company maintains a competitive position through its production scale, geographic diversification across Africa, Asia, and the Mediterranean, and a renewable energy portfolio that is expanding. However, the energy sector faces structural headwinds from energy transition pressures and commodity price volatility. The StokTok score for Eni is 26 out of 100, which signals an avoid rating. Breaking that down, valuation scores 6 out of 20, indicating the stock is not attractively priced. Financial health scores 9 out of 20, suggesting material stress. Profitability scores only 2 out of 20, showing very weak earnings efficiency. Growth scores 7 out of 20, indicating contraction or flat expansion. And smart money scores just 2 out of 20, meaning institutional conviction is minimal. Overall, the composite score indicates significant structural challenges. Now, valuation. The question every investor has to answer: are you paying the right price? Eni's trailing 12-month price-to-earnings ratio is 32.41 times. To put that in perspective, an energy major at that valuation multiple is expensive relative to historical precedent. The forward price-to-earnings, that is, the multiple based on next year's expected earnings, sits at 9.36 times, which is a significant compression, suggesting the market believes earnings will expand materially. The price-to-earnings growth ratio, or PEG ratio, stands at 1.24. A PEG below 1 typically signals that growth expectations may justify the current valuation. However, in this case, the underlying growth picture is weak, which we will address shortly. The enterprise value to EBITDA multiple is 4.58 times. For a large-cap energy producer, that sits in a moderate zone, but the denominator, EBITDA, reflects commodity price assumptions that may prove optimistic. The price-to-sales ratio is 0.88 times, suggesting the market is not dramatically overvaluing the top line. Our analysis of Eni's intrinsic value, based on discounted cash flow methodology, suggests the stock is trading at a 0% margin of safety, meaning the current price sits at fair value with no discount available to provide a margin for error. In practical terms, there is no cushion. Wall Street analysts have a consensus mean price target of $56, with a high target of $64 and a low of $49. 5 analysts are covering the name, and the consensus view is to hold, neither strongly accumulate nor exit. Market sentiment around Eni leans neutral as of the most recent data review. The latest earnings results require careful attention. The most recent quarter reported revenue of $19.74 billion, which missed the estimate of $84.48 billion by a significant margin. However, this miss reflects timing and segment reporting. The revenue figure of $19.74 billion represents the quarterly actual in absolute terms. Net income came in at $1.07 billion, and operating income was $0.63 billion. Revenue declined 4.2% year-over-year, which signals contraction in the core business. After-hours reaction to these results was flat, which suggests the market had already priced in the earnings miss. In our view, the valuation does not reflect a meaningful margin of safety given the earnings headwinds and the commodity-linked nature of the business. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point financial health checklist developed by Professor Joseph Piotroski, evaluates profitability trends, asset quality, and leverage changes. Eni's F-score is 6 out of 9, which places it in the middle range. A score above 8 typically signals robust financial health. Below 5 suggests material deterioration. At 6, the company shows mixed signals. Some financial metrics are stable or improving, while others reflect pressure. The Altman Z score is a multi-factor bankruptcy risk model that blends profitability, liquidity, leverage, and solvency. Eni's Z score is 1.83, which falls in the gray zone. Scores above 3 typically signal low bankruptcy risk. Scores below 1.81 signal high distress risk. At 1.83, Eni sits right on the boundary between caution and significant distress. Any material deterioration in earnings or cash flow could trigger a downgrade to the distress zone. Cash relative to debt stands at 0.55, meaning the company has 55 cents of liquid cash for every dollar of debt outstanding. This is below the 1-to-1 benchmark that provides comfort. Interest coverage, that is, operating income divided by interest expense, is 0.54 times. This is deeply concerning. A coverage ratio below 1 means the company's operating income cannot fully service its interest obligations, creating dependence on asset sales, refinancing, or dividend cuts to remain solvent. The current ratio, measuring current assets against current liabilities, is 1.47. A ratio above 1.5 is typically considered healthy. At 1.47, Eni has near-adequate short-term liquidity but limited margin for a sudden shock. Debt to equity stands at 0.74, which is moderate for an energy major, but given the weak interest coverage, the absolute debt burden is a constraint on financial flexibility. In our view, Eni's balance sheet is not broken, but it is stressed. The company has limited financial margin for error, and any material decline in commodity prices or operational disruptions would pressure liquidity and likely force management to curtail capital spending or reduce dividends. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or ROIC, is a measure of how effectively management deploys shareholder and debt capital to generate earnings. Eni's ROIC is 2.05%. For context, a ROIC of 8% or higher is generally considered healthy for a capital-intensive business. 5 to 8% is acceptable. Below 5% suggests capital is not being deployed efficiently. At 2.05%, Eni is returning just 2 cents of profit for every dollar of capital invested, which is materially weak. Gross profit margin, the percentage of revenue remaining after direct costs of production, is 10.39%. This reflects the commodity-linked nature of the business. Margins compress when oil and gas prices fall. Operating margin, which measures operating profit as a percentage of revenue, is 4.76%. This is thin for a large-cap energy producer and suggests significant overhead or operational inefficiency. Net profit margin, the final line, is 3.02%. This means that for every $100 of revenue, Eni retains just $3 of net profit. Free cash flow margin, operating cash minus capital expenditures, expressed as a percentage of revenue, is 3.06%, nearly identical to net margin. This indicates that the company generates minimal discretionary cash after funding its operations and reinvestment. In the most recent quarter, operating income was $0.63 billion on revenue of $19.74 billion, translating to an operating margin of roughly 3.2% in that period. This represents compression relative to the trailing 12-month average and signals near-term operational pressure. In our view, Eni's profitability profile is weak. The business is returning minimal cash to shareholders relative to the capital employed, and margins are compressing, not expanding. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is negative 14.7%. This means Eni's annual revenues have contracted significantly over that period, likely driven by a combination of commodity price declines, operational challenges, and energy transition headwinds. Over the past 5 years, revenue growth is positive 13.1%, which reflects recovery from a trough, but masks the recent downtrend. The trajectory matters. The 3-year decline is the more relevant signal. Book value growth, which measures the expansion of shareholder equity per share, is negative 0.3% over 3 years. This near-flat performance suggests management has not created tangible value for shareholders. Capital is being deployed to maintain the business rather than expand it. In the most recent quarter, revenue of $19.74 billion declined 4.2% year-over-year, confirming the contraction trend persists. The dividend yield stands at 4.19%. While this may appear attractive on the surface, it is critical to note that a high dividend yield on a declining stock price and deteriorating earnings can signal unsustainable payout ratios. Eni's dividend must be scrutinized against free cash flow generation, and given the 3.06% FCF margin, the sustainability of that 4.19% yield is questionable if commodity prices remain under pressure. In our view, Eni is not a growth story. The business is contracting, not expanding. Shareholder returns are being funded by cash generation that is being pressured by margin compression and commodity headwinds. Now let's talk smart money. What institutional capital is actually doing with this name? Top-tier investment gurus, as tracked by institutional holdings databases, currently hold Eni in 4 portfolios. That number is modest. Major energy positions in leading hedge fund and value manager portfolios tend to attract broader guru participation. Among the 13F institutional filers, meaning institutions with at least $100 million under management that must disclose holdings quarterly, 2.1% are net buyers, meaning they increase their positions from the prior quarter. For context, a threshold of 50% net buyers signals bullish institutional sentiment. At 2.1%, the signal is unmistakably bearish. Institutional capital is not accumulating. It is either flat or exiting. Insider ownership is 0.0%, which means management owns virtually no equity in the company. This is a material red flag. When executives and directors hold little or no personal stock, the alignment between management incentives and shareholder value creation is weak. Over the past 3 months, there have been 0 insider stock purchases and 0 insider stock sales. The absence of buying activity, particularly during periods of equity weakness, suggests insiders lack conviction in the investment thesis. In our view, the smart money picture is decidedly negative. Large institutions are not accumulating the position. Gurus are holding only modest stakes, and management owns nothing, which eliminates a key signal of internal confidence. When you combine weak institutional flows with 0 insider activity and minimal management ownership, the data is telling you that professional capital does not believe in the investment opportunity ahead. And finally, the verdict. Let's bring it all together. On valuation, Eni offers no margin of safety at current levels, with a trailing price-to-earnings ratio of 32.41 times and a DCF fair value assessment suggesting 0% margin to intrinsic value. There is no cushion for disappointment. Wall Street consensus is hold, not buy. On financial strength, the balance sheet is stressed. Interest coverage of 0.54 times is dangerously low, and the Altman Z score of 1.83 places the company in the gray zone between caution and distress. Debt service is not covered by operating income, which is a structural constraint. On profitability, Eni is weak. A return on invested capital of 2.05% is unacceptable for a mature capital-intensive energy producer. Net margins of 3.02% and operating margins compressing in the recent quarter signal that the business is not generating adequate returns. On growth, the company is contracting. Negative revenue growth over 3 years, near-flat book value growth, and a declining earnings base mean the business is not expanding. The dividend yield of 4.19% must be viewed with skepticism, as it may not be sustainable if commodity prices remain under pressure. On smart money, institutional conviction is absent. Only 2.1% of 13F filers are accumulating. Top gurus hold minimal stakes, and insiders own 0% of the equity and have not bought shares in the past 3 months. The most recent quarter's results, with revenue missing expectations and margins compressing, reinforce that operational momentum is negative. In our view, Eni's structural setup is challenging. The company faces a combination of valuation stress, balance sheet pressure, weak profitability metrics, and negative institutional flows. This does not appear to be an attractive risk-reward opportunity for long-term investors. A reduction in commodity prices, further operational deterioration, or refinancing pressure could trigger a material re-rating. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Eni SpA. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.